If you're a professional in finance or just an investor trying to navigate today's extremely complex markets, and someone hands you a security certificate that says the word bond, what is your instant gut reaction? Do you automatically feel safe?
A vast number of people do. They associate that label with stability, with a senior claim, and, with a guarantee of fixed cash flows.
And that instinct, that comfortable reliance on a legal label, is precisely what Benjamin Graham and David Dodd want us to challenge today.
Right, because the legal label on the security is often wildly separated from the economic risk you're actually taking.
So the title is a convenience for the lawyers, but it can be a catastrophic misclassification for the investor.
Exactly. Titles can comfort you, confuse you, or, most dangerously, mislead you into accepting equity-like risk while settling for a fixed income return.
At the end of the day, what really matters is the security's true economic identity.
That's it. How it behaves after you buy it, where it sits in the capital structure, and what your realistic payoff expectation actually is.
Welcome to Capital Allocation Lab. This is the channel where we teach disciplined, long-term investing by revisiting classic books and core ideas explained clearly in today's context in calm, audio-first deep dives you can learn from any day you choose.
And if that's your style, timeless principles, rigorous analysis, and fewer hot takes, please like this deep dive and subscribe. That consistent support is the simplest way you can help us keep producing this kind of educational work for free.
Today, we are taking a deep dive into one of the most deceptively practical lessons from security analysis: how to classify securities in a way that fundamentally improves your judgment and protects your capital. It's all about moving past titles and focusing on economic behavior.
Right. We won't be approaching this like a dry textbook that simply says bonds here, stocks there. That clean separation is, it's basically a fantasy in the modern financial world, which is filled with hybrids and customized instruments.
So we need a framework designed for investor judgment, not just for legal pigeonholes.
Yeah.
So here is the map for this deep dive, so you know exactly where we are going. We'll cover 4 key areas today, moving from the legal basics to the practical application.
First, we'll quickly review the traditional bond versus stock split, the fundamental distinction between being a creditor and being an owner.
Second, we'll walk through 3 foundational objections Graham and Dodd raise against relying on that traditional labeling: why preferred stock is misgrouped, why the bond label is dangerously confused with safety,
and why modern securities often just defy any neat categorization.
Third, we'll unveil their more useful framework, the 3 behavioral buckets, which classifies a security by its normal risk and profit behavior after purchase. We're really shifting the focus from the certificate to the payoff curve.
And finally, we will spend dedicated time on application and nuance. This means walking through their 5-step framework for analysis, showing how price and maturity shift securities between buckets.
And detailing the common mistakes this analysis helps us prevent.
In plain English, the goal is to teach you how to ask, what am I trying to get? What is the full range of potential loss? And what would have to happen for me to do really well? And then ensure your security actually matches your answer.
Before we start, as always, this is educational content only. It is not investment, legal, tax, or accounting advice. We are here to talk about ideas and frameworks so you can make disciplined, informed decisions.
All right, let's begin, as the classics do, with the fundamental classification we all learn: bonds versus stocks.
Okay, so this initial legal split isn't arbitrary, right? It's important to respect it as the starting point because it reflects a fundamental difference in how the capital structure is built.
Precisely. On one side, you have the bondholder, who is a creditor. When you buy a bond, you are lending money. The company owes you a fixed claim, specifically, stated interest payments, and the return of principal all on stated contractual terms.
And because that claim is fixed and it's senior, it is generally associated with higher safety and, naturally, lower potential returns compared to equity. The return is capped by the contract.
Right. And then on the other side is the stockholder, who is an owner, a partner in the business. You don't have a fixed claim. You are the residual claimant.
You receive what is left over only after all senior claims, debt, taxes, trade creditors, and sometimes preferred stock have been fully paid. You share in the profits only if they actually exist.
This ownership identity is associated with higher operational risk because you absorb the first losses, but it also provides potentially unlimited gains if the business succeeds spectacularly.
So that is the crucial distinction we must hold on to. The legal structure of the claim is fundamentally different. One is a loan with fixed terms.
And the other is a share of ownership with residual rights.
But here is where Graham and Dodd introduced the critical caution. While the structure is different, they argue strongly against equating the label bond with guaranteed safety. That's where the analysis begins to break down in real-world application.
Their point is so foundational. Safety isn't a title you pay for. Safety is an objective relationship between the legal claim you hold and the actual economic earning power and assets that stand behind it.
So if those assets and earnings are insufficient, the senior title is, well, it's meaningless.
Completely. We need to keep that principle at the center of our analysis. Safety is measured by coverage and capacity. We will revisit that idea multiple times as we move through classifying issues by their true economic status, not their nameplate.
Okay, so let's look at the first common error caused by relying purely on legal labels, the misgrouping of preferred stock.
Right.
Why do textbooks traditionally place preferred stock exactly between bonds, debt, and common stock equity?
Well, because it's convenient. It fits the legal hierarchy perfectly. Debt is senior, preferred is a hybrid form of equity, and common is pure equity. It also aligns with corporate law categories and how the securities are reported in financial statements.
But Graham and Dodd argue that this convenience comes at a significant cost for the investor. If you are constructing a portfolio based on economic function stability or growth, this clean legal ladder can mislead you entirely.
Let's think about the investor's purpose. Why does the typical investor buy a standard preferred stock? They are primarily buying it for income, which is a stated dividend rate, and they expect principal stability, a stable market value, at least relative to the wild swings of common stock.
So they are explicitly not buying it to participate in the full, unconstrained upside of the business.
No, if they wanted that, they would just buy the common stock.
Mm-hmm.
They are treating preferred stock as a senior income claim, often as a bond substitute.
And here's where the confusion arises. Legally, preferred stock is equity. But practically, for the investor, it often behaves and is intended to be held like a debt instrument for portfolio purposes, a source of stable cash flow.
Right, let's ground this in its mechanics. A standard preferred stock has a stated dividend rate that is senior to common dividends, meaning the common shareholder generally can't receive their payout unless the preferred shareholder has been paid first.
It also typically includes a liquidation preference. So in the event the company dissolves, the preferred shareholder has a stated claim on assets that ranks ahead of the common shareholder.
And crucially, separating it from the common stock owner identity, most preferred shares have limited or zero voting rights. They are not active partners controlling the direction of the business.
So if your goal is a steady payout and principal stability, the preferred share mimics a senior income claim. But now we introduce the critical nuance that explains why the legal label matters for a risk.
Which is that preferred dividends are often not an unqualified obligation.
That is a fundamental difference from bond interest, isn't it? Bond interest is a contractually unqualified obligation. If a company fails to pay bond interest, it results in an event of default and potentially bankruptcy or restructuring.
Exactly. With preferred stock, the board of directors can generally suspend the dividend without triggering an immediate default or bankruptcy. The dividend usually accumulates, it's cumulative, but the investor cannot force the issue legally the way a bondholder can.
And that, right there, is why preferred stock is not automatically as safe as a good bond. If the business hits a rough patch, management has the operational flexibility to stop paying you, which they don't have with straight debt.
So the takeaway here is not to treat preferred stock as a bond, but to recognize that it belongs in the same analytical family as debt when classifying by purpose. Seeking steady income and principal stability versus seeking capital growth and residual upside.
And if you mix these purposes in your portfolio thinking, you end up with portfolio results you just didn't sign up for.
Definitely.
Now we move to Objection 2, and this is the one with the largest psychological impact on the average investor. It's the dangerous association of the word bond with automatic, unquestioning safety.
This is a classic branding problem, as you mentioned earlier. The word bond sounds official, it sounds like a promise, and it's carried prestige for centuries. Investors incorrectly translate that legal promise into automatic financial protection.
And Graham and Dodd are unequivocal. This attitude is fundamentally unsound. They teach that a bond is only as safe as the issuer's economic ability, not just their legal willingness to meet those fixed contractual obligations.
Right. Let's illustrate this concept, the fixed claim on nothing. Imagine a business is essentially a shell company with significant debt, but minimal volatile earnings and assets that are technologically obsolete.
Okay.
If that business has no real underlying assets and no steady earning power, its bond is worth no more than its common stock.
A fixed claim on zero value is still zero value. You can take that fixed claim to court, but if the well is dry, the judge can only rearrange the empty buckets.
That's the core insight here. The bond form itself does not create safety. Safety is a derivative concept. It only appears when the business demonstrates sufficient earning power and robust asset backing relative to all its fixed obligations.
When repayment is probable, then safety exists.
Exactly. And we measure this safety using coverage ratios. How many times over can the company's operating earnings cover its interest expense and asset capacity? How much valuable collateral is there if the earnings stop?
The investor trap here is really insidious. Investors often consciously limit their return by accepting the fixed, lower coupon of the bond, assuming that in doing so, they have automatically limited their risk exposure.
But if the underlying business is truly fragile, you have achieved the worst of both worlds. You've capped your upside, settling for a low fixed return while retaining full downside exposure if the business collapses.
The bondholder experiences the loss just as surely as the stockholder, only without ever having the upside potential of a recovery.
And the legal enforceability of the fixed claim doesn't save you from a permanent loss of capital. In a default scenario, legal remedies like bankruptcy or restructuring don't magically generate cash. They simply rearrange the hierarchy of claims based on the impaired value of the business.
Right. So if the business is fundamentally worth less than its total outstanding debt, even the bondholder, despite their seniority, will incur a painful loss, often receiving pennies on the dollar or, worse, new, highly diluted equity in the reorganized company.
So the major lesson from Objection 2 is one of personal responsibility. Never outsource your feeling of safety to a label provided by the issuer. For long-term capital allocators, the fundamental question must always be, is this a bond of a business that fundamentally has the capacity to pay under adverse circumstances?
Okay, that makes perfect sense. So let's tackle the third objection, which is perhaps the most relevant to today's complex capital markets. Titles often fail to describe issues correctly because so many modern securities are deliberately designed not to fit the standard patterns.
This blurring of lines was already a significant issue in Graham and Dodd's time, and it has only accelerated since. Financial engineering constantly produces instruments that modify, combine, or blur customary provisions, creating hybrids that are neither pure debt nor pure equity.
So if you classify by title alone, if you simply assume a preferred stock behaves like a preferred stock should, you will misclassify an ever-increasing percentage of real-world securities, leading to unexpected risk.
And to appreciate the deviation, we first need to cement the three clean standard patterns, or archetypes, which serve as reference points.
Okay, pattern 1, the straight bond, the pure archetype. It carries the unqualified right to fixed interest on fixed dates and the unqualified right to fixed principal repayment at maturity.
Crucially, it provides no further interest in the assets or profits, no residual upside, and typically no voice in management. It's a fixed claim on a fixed schedule. That's it.
Then pattern 2, the straight preferred stock. It has a stated dividend rate in priority to common, but those dividends are generally not absolutely mandatory like bond interest.
It comes with a stated principal preference in dissolution ahead of the common, and usually limited or no voting rights, reflecting its quasi-debt function.
And finally, pattern 3, common stock. Pro rata ownership of the residual assets and residual profits after all prior claims. This ownership carries pro rata voting rights, making the holder the true decision maker.
So those are the ideal types. But the reality is that the vast majority of securities you encounter have deviations that break these patterns. Understanding these deviations is absolutely crucial for confident capital allocation.
Right. Let's start with deviations that break the most important feature of the straight bond, the unqualified right.
We see instruments like income bonds, where the payment of interest is contractually made contingent upon the company achieving sufficient income. This radically shifts the risk profile.
How so?
Well, a straight bond pays interest even if the company is losing money, drawing down capital. An income bond might not.
So that move turns the interest payment from a mandatory fixed charge into a variable claim dependent on operational success. It's a blend of debt and equity mechanics right there in the coupon.
Exactly. Then we get into deviations that link the senior instrument directly to equity upside, introducing optionality that fundamentally changes the payoff curve.
The most famous examples are convertible bonds and convertible preferred stocks. These grant the holder the option, but not the obligation, to convert the senior claim into a predetermined number of common shares.
The option is an embedded call option on the company's stock. If the stock price skyrockets, the investor converts and participates in the residual upside. If the stock falls, the investor retains the bond floor and the fixed payments. It's a composite security. Debt safety plus equity potential.
And there's a related but distinct deviation involving bonds and preferred stocks with stock purchase warrants attached.
Right. The warrant is essentially a detachable option to buy stock at a fixed price.
The key difference from a convertible is that the warrant is separate, isn't it? If you exercise a convertible, you surrender the bond. If you exercise a warrant, you retain the bond and pay extra cash to buy the stock.
That's it. Warrants often provide greater speculative leverage, allowing the investor to hold both the senior claim and the equity upside simultaneously.
We also see participating preferred stocks. These are not satisfied with just their stated dividend. They also get to participate in additional profits with common shareholders, blurring the line between fixed income and residual ownership even further.
And the blurring also happens on the equity side. You might see common stocks with preferential features. For example, a common stock that retains a special senior dividend or is protected by specific covenants, usually only found in debt agreements.
Or consider non-voting common stock. Economically, it's a residual claim, but it lacks the governance role fundamental to Pattern 3. This separation means the investor is reliant entirely on the actions of the voting shareholders and management.
One of the most disruptive deviations for an income investor is the blurring of payment type. This occurs when bond interest or preferred dividends are payable not just in cash, but also in common stock.
Today, we call these pay-in-kind or PIK features, often seen in high-yield debt or specialized preferreds. If the issuer pays interest with more debt or more preferred stock, PIK, or offers a dividend in stock option, the cash flow profile changes entirely.
Totally. If a company pays you in kind, they're signaling cash flow stress. As an investor, you might receive the stated coupon amount, but you receive it in paper, not cash.
So it's effectively a forced reinvestment in a company that may be struggling, and it converts your immediate cash return into a contingent capital gain.
Exactly. And finally, let's discuss callability. While not strictly a hybrid feature, it radically alters the payoff curve for the fixed value investor. Call features mean the issuer can redeem or pay back the security early under certain terms, often at a slight premium to par.
This is so crucial to understand. The call feature is an option held by the issuer. The investor is effectively short that option.
Right. So if interest rates fall, the price of your bond would naturally rise. But if it rises too much, the issuer will call the bond, pay you back, and refinance the debt cheaper.
The result is that callability limits the investor's upside. If rates plummet, you don't capture the full appreciation of the bond's price. Instead, you are forced to reinvest that principal at the new lower market rates.
So the conclusion from this section is undeniable. The more complex and hybrid the security, the less an investor can rely on simple pigeonholes like bond or stock.
Yeah.
The classification based on legal title is simply inaccurate when faced with these combinations of options and payment methods.
Which brings us directly to Graham and Dodd's solution, the framework based on actual observable behavior.
The core of the Graham and Dodd framework is a fundamental shift in perspective. We move from analyzing the legal structure to analyzing the economic reality of ownership. You must classify the security by its risk and profit characteristics as the buyer owner would reasonably view them.
This is not just an academic exercise. It's about aligning your security choice with your financial objectives. And crucially, this classification depends not just on the terms, but also on the price you pay for it.
That's such a key point. A high-grade bond bought at a normal price is analytically distinct from that exact same bond bought at a distressed price of, say, 50 cents on the dollar. The terms are identical, but the behavior and the investor's intent are radically different.
Okay, let's go through their three essential behavioral buckets. These are categories of economic function, not legal structure.
Okay, so bucket 1, securities of the fixed value type. This bucket represents the closest thing to the traditional concept of senior, safe investment.
The primary characteristics here are clear. Prospective change in principal value holds only minor importance. The dominant interest for the investor is the safety of principal, and the primary purpose is steady income.
The typical occupants are high-grade bonds and high-grade preferred stocks, key phrase, at normal prices. Normal prices meaning prices that reflect credit safety in current interest rate environments, not distress or massive speculation.
The investor mindset is essential here. They are seeking to get paid the interest or dividend and to get their principal back at maturity or upon sale. They are not hunting for a major capital gain.
And Graham and Dodd make a fascinating observation about investor behavior in this bucket. Even though high-grade bond prices do fluctuate based on interest rate movements, If rates go up, the price drops. Investors in this category often treat the security like a contract to receive cash flows, ignoring those rate-driven price swings.
So if they are genuinely holding to maturity or holding for a fixed future liability, they often fare better by ignoring the noise of the mark-to-market fluctuations caused by rate changes. The risk of loss is simply the risk of the issuer defaulting, which, by definition, should be low for a high-grade classification.
This highlights a key insight. Fixed value classification is partly about the security's quality and partly about the investor's intent. If the investor's intent is to trade for capital gain, or if their time horizon is short and rates are volatile, the security instantly shifts out of fixed value territory and into variable value.
It's the highest form of disciplined allocation, knowing your purpose and adhering to it, even when the market throws curveballs.
Exactly. Okay, bucket 2. Senior securities of the variable value type. This bucket describes senior instruments that still have a priority claim, but where prospective changes in principal value are significant. Price movement matters deeply, whether due to potential sale or a real possibility of gain or loss.
And the variable value here can stem from two very different places, which is why Graham and Dodd separate this into two important subtypes.
Right. Subtype A, well-protected issues with profit possibilities. These are senior claims where the credit protection, the bond floor, is sound, but an embedded feature gives the investor a realistic chance for a major capital gain.
The quintessential example is a high-quality convertible bond. It has the seniority, the contractual payments, and the underlying credit strength. But it also has an equity-linked option that, if the stock performs well, can generate significant profits.
The goal of buying subtype A is strategic. Obtaining the safety of a straight investment, that contractual floor, combined with added profit possibility via the embedded option. You are paying a premium for that combination, effectively buying insurance against a stock collapse while participating in the upside.
Now contrast that with subtype B, inadequately protected issues. The very name tells you the situation is different.
Right. In this category, a definite risk of loss is recognized by the market, and that risk is acknowledged in the low price. This risk is balanced only by a corresponding chance of profit if things improve.
So typical occupants are lower-grade bonds, sometimes called junk bonds, distressed preferreds, or senior issues of otherwise shaky companies. You're taking on significant credit risk.
They still differ from common stock in two ways, though. First, they retain effective priority over some junior issue, usually the common stock. And second, their profit possibilities tend to have a definite contractual limit. You still generally only get back par plus interest.
However, here's the behavioral twist that makes them variable value. When these issues are bought at a deep discount, say 50 cents on the dollar, the percentage gain to par, a 100% gain, can be huge.
Right. And this significant potential capital appreciation means the investment decision is driven by the profit hunt, not by the stability hunt. You are no longer acting as a fixed value investor seeking stable income. You are acting as a variable value investor speculating on the spread tightening or the credit recovery, even though the legal label is bond.
That blurring between subtype B of the variable value category and pure residual ownership leads us straight to bucket 3, common stock type.
This bucket is defined by payoff behavior. It includes any issue whose outcome is driven primarily by the enterprise's residual value and fortunes, regardless of the legal title on the certificate. It is effectively an ownership bet.
And this is where we see the most dangerous classification errors. How can a security with a senior title, like a bond, end up behaving purely like common stock? Graham and Dodd provide two main paths.
Path 1. When the price is too high, meaning the market is assigning an overwhelming value to the equity participation.
Okay, so take a convertible bond with a face value of 100, currently trading at 200 because the underlying stock has doubled. The investor buying at 200 is fundamentally paying 100 for the bond floor and 100 for the equity option. The fixed protection provided by the $100 claim is now a minor component of the investment.
At that price, the instrument will move dollar for dollar with the stock. You're exposed to the full volatility of the equity market, and your investment thesis is purely based on the continued success of the underlying equity. It may be legally a bond, but economically it is equity.
Okay, and path 2, and this is the most critical to understand, when the price is too low, which happens in situations of deep distress.
Right. Imagine a senior issue, a bond, selling for 10 cents on the dollar. The business is failing. At this price, the debt is so high relative to the perceived value of the assets that all junior securities, the preferred and the common stock, are essentially worthless. They have no meaningful equity value cushion left.
So in this extreme situation, the low-priced senior instrument is no longer a stable senior claim being protected by a layer of junior capital. Instead, the bondholder has become the de facto owner. The bond functions as the residual claim on a distressed enterprise.
And the recovery of the bondholder depends entirely on whether the business can be successfully restructured or if the assets can be liquidated for more than the market currently estimates. This requires a speculation on a turnaround, a bankruptcy outcome, or a successful asset sale. That is the definition of an equity-like bet.
This is the ultimate behavioral trap. An investor may tell themselves, I'm conservative, I own a bond, while their portfolio holds distressed debt that behaves exactly like a levered equity position, requiring management intervention, a restructuring, and long-term operating improvement to generate a return.
The principle is firm. The bond form never guarantees bond behavior. The behavior is dictated by price and the underlying health of the business.
Okay, so now that we have the three buckets, fixed value, senior variable value, and common stock type, we need to talk about real-world application, because the boundary lines between these buckets are inherently indefinite and always shifting.
That's right. Borderline cases are common, and in those situations, the investor should always analyze the security from both standpoints. The variables of price and time horizon are what make this analysis so dynamic.
Think about maturity and price. A short-term claim that matures in 18 months, currently trading at 80 cents on the dollar, promising to pay 100 at maturity, has a built-in 25% price move over a short period. Even if it's the high-grade bond, that guaranteed capital gain makes it analytically variable value.
Conversely, consider a long-term, genuinely high-grade bond trading low, say at 90, purely because general interest rates have risen recently. If the investor's purpose is to hold for income until maturity and they fully believe in repayment, they can rationally treat it as fixed value. The price fluctuation is irrelevant to their specific goal.
But the moment that investor decides to sell early, or if they need the capital, the classification changes, and they must recognize the variable value consequences of the current interest rate environment.
And the interaction of convertibility and price is equally complex. If the conversion feature is so far out of the money that the stock would have to triple just to reach the conversion point, the convertible acts entirely like a straight bond. It's fixed value territory. The equity option is economically irrelevant.
But if the stock price is near or above the conversion level, the convertible instantly trades at a premium to its principal claim. It behaves and must be analyzed exactly like equity moving into the common stock type bucket because the return driver is now the residual value of the stock, not the fixed claim.
This brings us back to the extreme example they highlight. A preferred stock with a par value of 100 trading at 10 cents. Why is this not an income security?
Because it fundamentally lacks the prime requirement of a senior security, a substantial junior cushion. The common stock is signaling that the enterprise value is so low that the preferred stock is unprotected.
And the upside potential, a 400% to 900% gain if the company recovers to par, is massive. Such a potential return demands a high degree of speculation and analytical risk-taking, relying on a heroic recovery. It requires the investor to assess the viability of the whole enterprise, which is common stock type behavior.
In other words, we must distinguish between an income security, which offers a stable return with high probability of principal return, and an income story, where the underlying thesis is purely recovery and speculation.
That's a great way to put it. So given the complexity of modern hybrids and the fluid nature of these buckets, we need a practical, step-by-step framework to ensure our security classification matches our investment purpose.
This is where we convert Graham and Dodd's observations into a repeatable analysis. We must always match the security's actual behavior to our intent.
Okay, step 1. Write down promises and options. You must read the full prospectus, or at least the summary of terms. Identify the coupon or dividend rate, payment dates, maturity or perpetuity, call provisions, and any conversion terms or warrants. Crucially, look for those structural deviations like pay in kind, PIK features, or dividend stock options.
So this step translates the legal jargon into a clear list of contractual cash flows and embedded optionality. Are you long a call option, convertible, or short a call option, callable bond? That's the core output of step 1.
Exactly. Step 2. Map the capital structure. This is non-negotiable for senior claims. You must know who gets paid before you, and critically, who gets paid after you. A senior security only has economic life as a senior security if there is a meaningful, valuable junior cushion beneath it to absorb losses first.
If you are a bondholder, what is the value of the preferred and common equity after your claim? If that cushion is thin or non-existent, your seniority means nothing, and you are analytically closer to the common stock type.
Right. Step 3. Identify the true driver of return. Based on the current price, what is truly going to generate your profit? Is it steady income and low volatility? Is it a capital gain realized from a mispricing, the difference between the low market price and par? Or is it equity optionality, the underlying stock price appreciating significantly?
So if the stock is the driver, you must use equity analysis tools. If mispricing is the driver, you need recovery and credit analysis. If income is the driver, you need stability and coverage analysis. Your tools must match the driver.
Yes. Step 4. Run simple scenario thinking. Don't just look at the current state. Ask, what happens in a normal year? If the business merely maintains the status quo, do I get paid? What happens in a recession? Is the cushion adequate? And critically, what would have to happen for me to experience extreme upside?
If extreme upside requires the common stock to double, you're in bucket 3. If extreme upside means you get repaid par in full after buying at 50, you're in bucket 2. If extreme upside means you hold to maturity and get your fixed interest and principal, you're in bucket 1.
Perfect. And step 5. Match the security to your purpose. After running the scenarios, you must check yourself. Do I need income stability? Then I must be in bucket 1 or subtype A of bucket 2. Am I hunting for upside participation? Then I must be prepared to accept the volatility and risk of bucket 3. The purpose must align with the behavior.
This classification exercise is more than just labeling. It dictates which capital allocation questions you need to ask about the underlying business.
Remember, every security is a contract, plus a claim on a business. The analysis must always focus on the business's ability to generate cash to service that claim. But what kind of cash generation matters depends on the claim type.
So if you are classifying the instrument as fixed value, bucket 1, your focus must be on traditional credit metrics. You focus on coverage ratios, stability of earnings across cycles, and asset protection, and the ability to refinance debt when it comes due. Can the business meet stable, boring obligations?
Right. And if you are in senior variable value, bucket 2, you care about all those credit metrics, but you must also be acutely aware of how market sentiment affects the price. You are focused on credit spreads, the difference in yield between your security and risk-free treasuries.
Credit spreads tighten in good times, making your variable value bond look safer and its price appreciate. They widen dramatically in stress, forcing a reprice and often demanding humility because your exit strategy relies heavily on market liquidity and stability.
And if you are in the common stock type, bucket 3, whether by high price or low price, your focus shifts entirely to ownership metrics. You analyze long-run earning power, competitive advantage, the return on invested capital, ROIC, and the quality of management's capital allocation decisions. The bond title is just noise.
It's the same business, but the economic reality of the claim forces you to ask fundamentally different questions about its viability.
We should also briefly mention how macro factors impact these buckets differently.
Okay, so fixed value securities are most exposed to interest rate risk. The classic example where the price drops when the central bank raises rates, and inflation risk, which erodes the real purchasing power of those fixed coupons over time.
If you hold that high-grade bond for 30 years, inflation matters deeply, even if the price doesn't. You are guaranteed a nominal return, but a real loss of purchasing power.
And variable value and common stock type securities are less sensitive to interest rate fluctuations, but are hypersensitive to the economic cycle and overall credit availability. A recession widens credit spreads, and the price of a subtype B variable value bond collapses.
So the framework helps you mentally manage these risks. If you are in bucket 1, you worry about the Fed and inflation. If you are in buckets 2 and 3, you worry about economic demand and default risk.
This disciplined classification is primarily a defense mechanism, isn't it? It's designed to prevent simple yet catastrophically costly mistakes made by investors who take mental shortcuts.
It absolutely is. Let's list the 5 key mistakes this framework helps you avoid.
Okay, mistake 1. Buying a bond or a preferred stock at par and assuming safety without conducting due diligence on the business's capacity to pay, only focusing on the willingness to pay.
Mistake 2. Buying preferred stock, expecting the high potential appreciation of common stock, a growth-like upside,
Right.
without recognizing the structural limits imposed by the fixed dividend and the discretionary nature of the board's payment risk.
Mistake 3. Buying a hybrid instrument like a convertible without clearly defining whether you are primarily paying for the bond floor, the safety, or the equity option, the speculation. Paying for the option without realizing it is highly expensive.
Right. Mistake 4. Looking at a low-price senior security, a deeply discounted bond, and labeling it conservative based on its original title, when its market behavior is clearly that of a highly speculative, distressed equity bet.
And mistake 5. Thinking titles are sufficient when embedded options, such as call features, conversions, or pay-in-kind structures, radically change the potential outcomes and the cash flow timing for the holder.
Well said.
So to fully internalize the risk, we need to understand the motivation behind these complex creations. Why do companies go to the trouble of issuing hybrids instead of just straight debt or straight equity?
Because they solve financing problems. Companies issue securities to optimize their capital structure, often driven by cash flow uncertainty, credit ratings requirements, or the perceived cost of capital at a specific moment in time.
Preferred stock, for instance, offers management great flexibility. Since the dividend can be suspended without immediate bankruptcy, it allows the company to conserve cash during tough times, a flexibility they simply don't have with mandatory bond interest.
And convertibles are often appealing because the issuer can raise capital while minimizing the immediate cash burden. They trade a potentially lower cash coupon now because investors accept the option value for the potential dilution of future shareholders later. They're essentially selling a delayed equity issuance.
And call features exist purely for the issuer's benefit. They allow the company to optimize their cost of capital by refinancing the debt when market interest rates fall or their credit profile improves, locking in lower payments.
So from the buyer's perspective, the issuer's choice of instrument signals specific trade-offs. The buyer must then rigorously classify the security based on its resulting behavior, which determines the outcome, not based on the issuer's optimistic story about why they chose that specific instrument.
Your portfolio does not care about the legal rationale for issuance. It only responds to the cash flows and risks it experiences.
Right, so let's summarize this detailed analysis with a quick rule of thumb, a set of questions you can ask immediately when presented with a new security.
Great idea. Question 1. If the business merely stays healthy, maintaining current earning power and assets, do I get paid the fixed interest or dividend without needing a favorable market price move?
If the answer is yes, you are almost certainly in fixed value territory, bucket 1.
Question 2. Do I need a favorable change in price tightening credit spreads, a market recovery, or the equity option becoming valuable to achieve my targeted return?
If yes, you are in variable value territory, bucket 2. Your return relies on external factors or improvements in credit perception.
Question 3. If the business struggles or defaults, does my outcome depend mostly on the liquidation value or eventual turnaround of the entire enterprise, similar to an owner's bet?
If yes, regardless of the label, you are making a common stock type bet, bucket 3.
Question 4. What is the realistic range of outcomes? This helps distinguish the very narrow range of a truly high-grade, fixed-value bond from the widely uncertain range of distressed debt or equity.
And question 5, am I comfortable with the downside risk, given the potential upside is either contractually capped or not capped? You really want to avoid instruments where you cap your upside, say, at 100, but retain full downside exposure if the business goes to 0.
To provide an ultimate memory aid for our listener, let's wrap this up with 3 essential C's. These are the 3 core analytical points to remember when evaluating any security.
I think the 3 C's are perfect for this framework.
The first C, claim. What exactly am I legally and economically owed? This defines the upside cap and the promised cash flow.
The second C, cushion. What value sits beneath me? The junior layer of preferred and common equity to absorb losses before my senior claim is hit. This defines the downside protection.
And the third C, optionality. What embedded options call features, convertibility, PIT features, warrants shape my payoff. Are those options working for me or against me?
If you can answer those 3 C's thoroughly, you are thinking like Graham and Dodd. You've successfully moved past deceptive titles and into the realm of disciplined capital allocation.
All right, let's quickly recap the 3 essential behavioral buckets one last time.
Bucket 1. Fixed value type. High grade, straight senior securities at normal prices. Your purpose is steady income and high probability of principal stability. The price fluctuation is minor to your purpose.
Bucket 2. Senior variable value type. Senior instruments where price change is significant. This includes the well-protected convertible issues with profit possibilities and the inadequately protected low-grade issues where you seek profit as compensation for acknowledged risk.
Bucket 3. Common stock type. Any instrument whose behavior and outcome is driven primarily by the enterprise's residual value and fortunes, whether the price is too high, equity-driven convertible, or too low, distressed debt.
The meta lesson here is timeless. Boundaries are fuzzy, and they shift instantly based on price, maturity, and investor intent. You cannot afford to be passive.
But the most important, enduring takeaway is the foundation of value investing. Safety is not a name. Safety is the issuer's tested ability to meet obligations, supported by verifiable earning power and durable assets.
That's a timeless principle of capital allocation that applies in every cycle. What should our listener do differently after this deep dive?
First, when you see a security, don't stop at the legal label. Translate the label into its actual economic behavior using the three-bucket framework.
Second, rigorously match that behavior to your investment purpose. If you need income stability for a retiree, don't accidentally buy bucket 3, equity-like risk.
Third, in any hybrid instrument, understand precisely which options you are long and which options you are short. Never assume optionality is free.
And fourth, recognize that financial innovation will always produce new security forms. A resilient investment framework is based on cash flow priority and payoff behavior, which never changes, not on temporary legal titles.
That's exactly why we revisit the classics. The forms change, the incentives repeat.
Think of this channel as an audio-first library of capital allocation ideas you can return to whenever markets get noisy, complex, or, frankly, confusing.
Thanks for listening and for joining us on Capital Allocation Lab.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And we genuinely love to hear from you in the comments. What part of capital structure analysis is most confusing or challenging for you in your real-life investment process?
Or what fundamental investing concept would you like us to unpack next margin of safety for bonds? The debate between dividends versus buybacks, the concept of owner's earnings, or perhaps comparing ROIC versus ROE.
Leave your questions and topic requests below, and we'll build future deep dives around what you want to master next.
Until next time, stay patient, stay analytical, and keep allocating capital like an owner.